Now I would like to compare 4 different instruments that people use in order to fund startup companies. So these are 4 instruments that are available also for investors. The first one is the equity deal. The company issues equities. The second one is the convertible note, which is a loan that they can convert into equity. The third one is the initial coin offering, which is a crypto thing and a blockchain thing. And the last one is the venture loan, where you lend money to the company. The obvious and perhaps traditional way of investing in startups is to buy shares. So they make a capital increase, they issue some new shares, and investors come in and buy shares. How does that happen? How much do they give away? The kind of a standard is that a share increase, a capital increase, is about 30%. So the existing shareholders are diluted about 30%. But it can be anything else. I've seen almost everything. But 30% is kind of a market standard. So you do the seed round, the founders have 100%, then they do the seed, and now they only have 70%. And then they do the next round, and they lose 30% of the 70%. So now they're down to 50%. And it goes on like that. If in the end the founders have been diluted a lot, so much that some of the investors are concerned that they're not motivated anymore, then they might give them a new stock option package so that they kind of also have a way of getting some shares back, so to speak. And what is important to know is that in many cases where you have companies that become really, really big, but also go through many funding rounds with a lot of capital coming in, that it's not unusual that the founder team end up having only 10%. But you know what? 10% of $1 billion is $100 million. So it can be perfectly fine for the founders to accept being diluted like that if it is in a situation where the company grow and become very, very big. Now, if we go on to the convertible note, that is a different instrument, and it's mainly used at the earlier stages. It's very popular among angels, but it's also used among early stage venture capital funds. The way it works is that you issue a loan to the company that can be converted to equity. And there's an official trigger in the contract. It's typically if you do a capital increase of a certain amount or with a certain amount of shares, that the ones who have issued the convertible note can convert that loan to equity at a discount. How big is that discount? So at a discount to the new stock price. How big is that discount? There are no fixed rules for that. I've seen 50%, I've seen 20% or 10%. 20% is quite normal. So around 20% is something you see often. But there's some issues in it that are important to understand. And that is, if you have issued a convertible note to a company and you can convert it at a discount next time it raises capital, all else equal, you have an interest that the next time they raise capital, it is at a low stock price, because then you get in at an even lower stock price. Whereas surely the founders of the company, all the other shareholders, they want it to be a high price so they don't get diluted so much. Partly in order to address that conflict of interest, you have a cap. So you have a maximum conversion rate. So if the share price is much higher than this maximum price, you might end up having a much bigger discount. Maybe it says you can automatically convert at a 20% discount, but because the company is very successful and it raises money at twice as high price, your discount becomes much more. Maybe it's close to 50%. So this is one advantage you have when you issue a convertible note. The other one is that if instead of going very well, the company actually goes bankrupt, you have some potential advantage, because when a company goes bankrupt, anybody who has equities lose everything. Equities are the value of equities is zero. But in a bankruptcy situation, a solicitor is appointed to resolve whatever assets there are, And then as a creditor, because you still have issued a loan to the company, you have a claim on its assets. So you can claim assets worth all of what you have lent the company. And it might turn out that this is a springboard for doing a recapitalization, a restart of the company, where certainly you own everything. And you might, in such a situation, even see if you can get the existing management to continue to run the company. So you own everything, but now you give them stock options so they kind of can work themselves back into the game. A last thing I want to mention with convertible loans is that since you're not on the cap table, that in some situations it's a way of keeping your exposure away from the public until you actually convert the note. Very often this is not important, but sometimes it is. I think the key for many people is the first that you have this guaranteed discount at the next round, and the discount might become more or even a lot more than the guaranteed discount. And the second thing is that should things turn sour, that you have the claim of the assets because you are a creditor. Now let's move on to initial coin offerings. It's something that came on the back of the whole blockchain innovation. The idea is that a company can raise money simply by issuing a note or a loan certificate or equity certificate or some other token of value that can be traded freely by anybody, anywhere, via blockchain. There's a lot of technicality in how that works in the machine room, but from the perspective of the startup company that does it, it means that you bypass a lot of things. You bypass a lot of legislation because anybody in Kazakhstan, China, South America, New York, and so on, they can just trade this blockchain tokens. But you also bypass the angels, you bypass the venture capitalists, and so on. So it's in some perspective it's attractive because it's easy, and you can say all these the fees and term sheets and long form contracts and all the rest of it that you have to work your way through when you work with angels and venture investors. All of this is gone. And that was why it exploded on the scene in 2017 and 18. And for some months, the amount of ICO transactions in startups was bigger than the entire amount of angel investments and venture capital investment. It was incredible how that grew. But even as it did, some of the most professional people in blockchain were giving out warnings. They said that at least 90% of what goes on here is either unqualified or criminal. Criminal in the sense that you're really fooling the investors, that there was not the substance in the startups that they pretended there was. I personally was inundated via social media by proposals to invest in ICOs, and I never invested in a single one. But it is a way of funding companies. It's also a way of getting additional funding to companies that you have already invested in. But you just have to do it with your eyes open, I would say. The last funding technology or funding instrument that I want to mention is the venture loan. And I must admit, the first time, this is many years ago, but the first time I heard about venture loan, I was a bit surprised because I thought, why would anybody lend money to a venture capital fund, considering the significant risk of bankruptcy? Would you really want to lend money and say collect 5% interest if you have a significant risk of losing everything? However, when I looked closer at it, it turned out, first of all, that those loans are only issued to companies that are already quite solid. They are at break-even or pretty close to break-even. So it's not, in the early stage, super risky companies that get these loans. And second, they ask for a kicker in the form of an option to buy 1 or 2% or something like that of the company. And that kicker might actually have significant value. So venture loans can be relevant if you have a good case, if you have a good company, and it's a fairly late stage, you don't want dilution, you can see that you are able to pay back the loan within a few years or less, then there can be very good reasons to do the last funding, like the mezzanine funding, pre-IPO funding, bridge funding with a venture loan instead of doing it with issuing equities. So Silicon Valley Bank and others who do this the same, they have access to much cheaper, in a sense, money than venture capital funds have. So if they can get deposits where they only have to pay 2% interest or less, and they can invest it, and with a combination of a high interest rate and the equity kicker may end up earning 10-15% or so, they have a great business. So this is for late stage, but it's not insignificant, so it's very important. I might add, as the last funding form, of course you can get grants and public funding, which is simply in order to stimulate innovation. And it can come in the form of equity investments or loans or convertibles or a combination of those.